Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Talkspace Inc., ticker symbol TAC-AK, a company that has undergone, well, pretty dramatic transformation over the last several quarters. Our core thesis today is that Talkspace has successfully leveraged 42% payer growth and a $10 billion data AI moat to achieve GAAP profitability, positioning itself as a scalable B2B2C healthcare leader despite competitive and regulatory risks.
That thesis, yeah, it captures the core conflict perfectly. And it's crucial we spend time on the nuance here. For too long, Talkspace was defined by, the inherent volatility and high burn rate of a direct-to-consumer or D2C model, that endless cycle of high marketing spend chasing individual users.
The expensive part.
Exactly. What we're seeing now is a deliberate, costly, and ultimately, I think, successful shift toward a scalable B2B2C model. And it's underpinned by a proprietary technology stack that is deeply integrated into clinical practice. The financial turnaround, particularly achieving GAAP profitability, is undeniably real. But our job today is to critically assess the quality of that profitability and to ensure we fully grasp the inherent regulatory and technological risks that still remain in the digital mental health sector.
Absolutely. So for you, our listener, we're going to walk through this investigation logically. We will start by unpacking that strategic pivot that really defined Q3 2025, detailing where the accelerating revenue growth is truly coming from and the profound shift in their business mix.
Right.
Then we'll move into the core financial health, dissecting the profitability milestone, both GAAP and Adjusted EBITDA, and analyzing the impressive strength of their debt-free balance sheet.
Yeah, the balance sheet is key.
We will then spend significant time on their technological differentiator, that massive AI data moat and its specific clinical applications that drive safety and retention.
The AI moat, definitely central to the story.
Finally, we will assess their strategic expansion into key regulated markets, review recent acquisitions like Wisdo, and wrap up with the essential risks and deliver our final investment verdict based on their forward guidance.
Okay, it's time to start where the capital markets have historically, penalized them. The business model itself.
Okay, let's unpack this intentional mix shift gun, because this really is the engine of the entire turnaround story. Talkspace recognized that relying on consumers paying, $200 a month out of pocket, that just wasn't sustainable for scalable growth.
Not at all.
So the strategic decision was to pivot almost entirely toward the payer channel. That means insurance companies, employee assistance programs, EAPs, government programs, that sort of thing. This B2B2C approach fundamentally changes the math.
It changes the math dramatically. It addresses the single biggest drag on profitability in the old D2C model, customer acquisition cost, or CAC.
The marketing spend.
Exactly. When you are operating through a payer channel, you are benefiting from embedded referral volume. The insurer validates the benefit, the employer promotes it. This B2B2C funnel just offers far superior unit economics because the CAC is significantly lower. And crucially, customer retention, or as they call it, member lifetime value, is much longer.
Why longer?
Because the treatment is covered by an existing benefit. It's not subject to, consumer economic anxiety month to month.
Got it. And the Q3 results, they definitively confirm the success of that strategy, right?
Oh, absolutely.
Total revenue reached a record $59.4 million. That marks a substantial acceleration with a 25.3% year-over-year increase.
And that acceleration is especially powerful when you consider the economic headwinds facing generalized consumer spending right now.
Yeah, good point.
To put that in context, the primary engine driving that record revenue was pure payer dominance. Payer revenue surged an incredible 42.1% year-over-year.
42%, wow.
Reaching $45.5 million. This isn't just a slight bump. This represents a fundamental structural change in their financial plumbing. Payer revenue growth actually accelerated from the high 30s in previous quarters to over 42%, demonstrating, compounding success in contract implementation and getting people to use the service, the utilization.
So we've seen the success of the pivot. Let's define its size. The payer segment now accounts for approximately 77% of total revenue.
77%.
That mix shift has fundamentally changed the risk profile of the company, moving it from, like you said, a risky consumer tech platform to more of a regulated, contracted healthcare services leader.
That 77% figure is critical. It implies a high degree of revenue stability because that revenue is backed by multi-year contracts with major health systems and insurers. It provides predictable revenue streams that just aren't available in the consumer market. It confirms the strategic choice they made, sacrifice maybe some short-term growth in other areas for long-term scale and stability.
But every strategic shift has a cost, right? You hinted at that. We see that cost in the intentional contraction of the legacy DTC segments.
Right, you have to look at the other side.
We saw consumer revenue, the old D2C heart of the business, decline 23.1% year over year, falling to just $4.6 million.
Yeah, and that decline wasn't a failure. It was really a consequence of successful redirection. They are no longer spending aggressively on performance marketing to attract those cash-paying consumers. Instead, they're optimizing their outreach and marketing efforts specifically toward educating those same consumers that their mental health services are now covered benefits through their employer or insurance plan.
Ah, so shifting the marketing focus.
Exactly. They are directing that spending to the highest margin, most scalable channel.
Okay. Meanwhile, let's look at the third channel, direct to enterprise, or DTE. This encompasses large corporate contracts sold directly, bypassing the major health insurers. DTE revenue showed near stagnation, actually declined slightly, -1.2% year over year to $9.3 million. This raises a key question for me. If they are succeeding wildly in B2B2C with payers, why is the DTE segment struggling to provide any lift?
That's a phenomenal figure to pause on because it highlights the fundamental difference between the two B2B models. The payer segment leverages massive, established networks, right? So you get rapid deployment and immediate access to millions of lives.
Okay.
DTE, however, involved complex direct sales cycles to enterprise customers, often requires bespoke implementation, slower adoption rates. It's just a harder, slower sale. The stagnation suggests that their internal sales focus and investment have overwhelmingly prioritized the higher leverage payer channel, which is currently yielding much greater returns.
So a conscious trade-off.
Essentially, yeah. They are trading slow DTE growth for explosive B2B2C growth, which, given that 42% acceleration, seems like the strategically correct trade-off right now.
Okay, so if we synthesize this initial segment, the takeaway for you listening is clear. The accelerating payer growth, which was up from 35% in Q2, is now so significant that it drives the overall consolidated numbers. It's insulating the company from generalized consumer economic anxiety. Utilization is now structurally covered by insurance benefits, not discretionary consumer spending.
Precisely.
Yeah.
And this shift towards stability and scale is what enabled the company to hit the next major inflection point, achieving a sustained level of actual financial health, moving beyond adjusted metrics to statutory profitability.
And what a milestone that is. This is where the story shifts from promising turnaround to established financial discipline.
Yeah.
For the first time, they achieved sustained GAAP profitability in Q3 2025.
That is the headline that validates the entire strategic pivot we just discussed. They achieved GAAP net income of $3.251 million for the quarter,
$3.25 million.
marking a strong 73.5% year-over-year increase. Furthermore, income from operations, that's the profit generated purely from core business activities before interest, taxes, other non-operating effects, was $2.198 million.
So real operating profit.
Real operating profit. This proves the B2B2C model is inherently profitable at scale.
That GAAP metric is great, it signals statutory success. But given that this is still a growing technology-enabled healthcare company, analysts often focus on Adjusted EBITDA, right, to measure operational health and investment capacity.
Right, and that metric was even more impressive, frankly. Adjusted EBITDA grew a massive 111% year over year, reaching $5.0 million.
Double the previous year.
Exactly. The Adjusted EBITDA margin expands significantly to 8.4%. And if we zoom out for a wider perspective, the last 12 months, or LTM, Adjusted EBITDA reached approximately $11.9 million. That's up sharply from only about $4.0 million the prior year. The quality of this expansion is what stands out. The margin isn't just increasing, it's accelerating at a rapid rate because that payer utilization is flowing through efficiently.
That kind of margin expansion doesn't happen by accident, though. It points directly toward operational efficiency and cost discipline. It's not simply a revenue story, it's a controlled cost story, too.
It is the operating leverage inherent in the B2B2C model fully kicking in. We need to look at operating expenses, OPEX. If we normalize OPEX by excluding stock-based compensation and non-recurring expenses, they decline sharply as a percentage of revenue to just 34%.
34%, down
from 41% a year prior.
Wow, that 7-point drop in OPEX as a percentage of revenue is staggering, especially when revenue is accelerating at 25% YoY.
To put that 7-point drop in context, this signals a massive optimization of their internal processes. They essentially ramped up revenue by 25%, while total operating expenses were only up 4% year over year.
Only 4%? AVEX growth.
reaching $22.4 million. This is achieved by maximizing the embedded referral volume from the insurer side, significantly lowering their CAC, and also, crucially, by automating certain back-office and clinician support functions through early AI adoption. It demonstrates discipline, controlled spending across the board, proving management can operate leanly even while investing for explosive growth.
This financial discipline clearly extends to the balance sheet, which is remarkably strong. They operate with $0 debt.
Zero debt.
Which is incredibly rare for a growing telehealth company in this often capital-intensive market.
Their liquidity position is robust. Cash, cash equivalents, and restricted cash, including marketable securities, totaled approximately $96 million as of September 30, 2025.
$96 million.
That $96 million war chest, coupled with zero leverage, provides enormous strategic flexibility. Whether for weathering market volatility or pursuing opportunistic mergers and acquisitions, like the Wisdo deal we'll discuss later.
Okay, and to break down that $96 million for you listening, we saw $43.7 million in highly liquid cash and equivalents and $52.1 million strategically placed in marketable securities. And management is signaling confidence not just with words, but with direct action regarding capital return.
That's right. They utilized $8.8 million in Q3 2025 to repurchase and retire over 3.5 million shares.
Buying back stock.
That is a concrete signal to the market that management internally believes the stock is undervalued, especially when measured against that growing, scalable, profitable revenue stream. And there remains $11.8 million available under the existing $40 million repurchase program, suggesting that capital return is an ongoing priority.
Okay, so we have a successful strategic pivot, verifiable financial health. But none of this works in the long term if the service can be easily replicated by a competitor. The real secret sauce here, the genuine barrier to entry, seems to be the underlying technology. Let's pivot now to the heart of their competitive edge, that 10 billion data AI moat.
This raises a profoundly important question in modern healthcare, doesn't it? In a world where general large language models like GPT are ubiquitous, what exactly is Talkspace's proprietary advantage in the highly sensitive field of behavioral health AI?
It rests entirely on the quality and volume of their proprietary training data, from what I understand. Their proprietary behavioral health-specific LLM is trained on what analysts refer to as a 10 billion data AI moat. Let's drill down into that figure. This massive data set includes hundreds of millions of anonymized therapy transcripts, 8 billion words derived specifically from text therapy sessions, and 140 million messages exchanged between providers and members.
The key word there is contextualized. This isn't generalized internet data. It is real human, contextualized clinical interaction data gathered over years of practice. What's fascinating here is the distinct advantage this clinical training provides compared to general-purpose LLMs. Those are built on public web data and often lack the nuance and, crucially, the safety required for mental health applications.
Right.
CEO John Cohen specifically referred to general models lacking clinical oversight as dangerous, pointing to the risk of injury and even fatalities associated with general-purpose LLMs being inappropriately used for mental health assessments or advice.
And Talkspace is actively trying to prove they're not just smarter, but the safe option, which is essential, I imagine, for maintaining those large payer contracts.
Absolutely critical.
Their alpha testing results comparing their model to general LLMs were pretty astonishing. They showed a 50% improvement in identifying and responding to high-risk behaviors, such as suicidal ideation or imminent self-harm.
50% better at identifying risk. And beyond safety, the proprietary model achieved a 47% higher therapeutic quality score than general models.
So better quality therapy suggestions or interactions?
Essentially, yes. This shows that the AI doesn't just act as a guardrail, it actively contributes to the quality and efficacy of the clinical encounter. That focus on safety is translating directly into product integration and regulatory compliance. They didn't just rely on their existing suicide risk algorithm. They launched 3 additional proprietary risk algorithms.
3 more?
Yeah, now embedded into the platform, specifically for violence or homicidal ideation, substance use disorder, and maltreatment risk. This ensures clinical guardrails are deeply embedded, satisfying the rigorous demands of their payer partners.
But the AI isn't just about risk mitigation, right? It's also about efficiency and, crucially, retention. How is the AI integrated into the patient journey to improve core business metrics?
Well, the AI is driving tangible improvements in engagement. They implemented product platform enhancements, including sophisticated matching and scheduling algorithms.
getting the right therapist quickly.
Exactly. That directly led to a 50% increase in the number of clients attending their critical third session within 30 days.
50% more make it to session 3.
Right, and that third session is a key predictor of long-term adherence and positive clinical outcomes. This is operational AI, not just theoretical research.
And what about the providers themselves? Clinician burnout and workload are huge challenges in behavioral health. How does AI help them?
The AI acts as a genuine support tool for the human clinician. It provides smart insights and smart notes, automatically processing session data to streamline preparation and post-session work. Management estimates this saves providers 10 to 15 minutes per session.
That adds up quickly.
It really does. And critically, providers using smart insights were linked to members being 30% more likely to book that third session. So the AI is directly contributing to both provider satisfaction and improved patient flow. This self-reinforcing loop payer funnel brings users, generates data, trains AI, improves efficacy, improves retention, attracts more payers. That's the foundation of the moat.
They also relaunched their psychiatry segment, which targets high-acuity users needing medication management. I imagine AI support is crucial here for streamlining referrals and monitoring those higher-risk cases.
It is essential. This segment saw initial session volume increase 46% sequentially in Q3 2025.
46% growth quarter over quarter.
Yeah, a big jump. And that spike in volume was only possible because it was supported by the provider network growing by nearly 50% from Q2. This included focused efforts on cross-referral between therapy and psych, ensuring that the moment a high-acuity patient is identified, perhaps by the AI, the system is equipped to seamlessly transition them to appropriate pharmacological or integrated care. This bolsters the credibility of their comprehensive care model when dealing with major insurers.
This technological and provider expansion leads us directly into the largest story: market penetration. The payer pivot, backed by the AI moat, has led to really unprecedented market scale.
Indeed. Talkspace now covers nearly 200 million lives across major health insurers, employers, and EAP partnerships.
200 million lives covered.
Management convincingly argues that reaching this level effectively unlocks the total addressable market, the TAM, covering approximately 2/3 of the U.S. population. For any competitor, reaching 200 million covered lives is perhaps the highest barrier to entry imaginable.
And the scale is converting into utilization, which validates the entire model. The payer pivot is successfully converting coverage into actual engagement. Payer sessions increased 37% year over year, and unique active payer members increased 29% year over year.
29% growth in active members.
Reaching 120,000 members. This is the highest quarterly figure since the company's inception.
And to achieve that kind of scale, they've had to make targeted inroads into highly regulated, high-need markets where access has historically been difficult and trust is paramount. One prime example is the military community.
Right. Securing in-network coverage for all 10.5 million TRICARE members. That includes active duty personnel, their families and retirees. That's a massive strategic win. That segment has unique and severe mental health demands, requiring extremely high standards of security and clinical rigor. Talkspace successfully demonstrated they could meet that.
It validates their clinical safety systems, including that proprietary AI moat, against one of the most demanding payers in the world, the U.S. government.
Definitely.
And perhaps even more significant from a public health and scale perspective is Medicare. The platform is now live in all 50 states for traditional Medicare beneficiaries. The demand here is massive, given the growing need for mental health support in the aging population. And what's crucial to note is the reported clinical improvement rates for Medicare members were 84%.
84% showing improvement. That's strong evidence of efficacy.
It demonstrates efficacy in that older, high-need, and highly scrutinized population.
Further supporting that crucial Medicare strategy is a significant subsequent event that happened in October 2025. The acquisition of Wisdo Health. Tell us about that.
Yeah, Wisdo Health is a clinically proven AI-powered social health and peer support platform. This acquisition is strategically brilliant and perfectly timed. It's expected to drive significant engagement in the Medicare population, specifically because seniors often favor group coaching, peer interaction, and loneliness support models that Wisdo specializes in.
So it adds another layer of support beyond just therapy.
Exactly. It diversifies Talkspace's offering beyond pure 1.1 therapy, allowing them to provide scalable, lower acuity support within the existing platform. That makes them an even more valuable partner to payers.
And Wisdo isn't just about Medicare. It seems to open a high-value commercial door, too.
It does. The platform will immediately support Novo Nordisk's We Go Together app. That's designed for obesity management, specifically targeting users taking GLP-1 drugs like Ozempic or Wegovy.
Ah, connecting to the weight loss drug phenomena.
Precisely. That partnership revenue will be recognized in the direct-to-enterprise segment, DTE. This is a crucial validation point for that DTE channel, which, as we noted earlier, has been stagnating. Management views this as a crucial opportunity to get right the first time around before pursuing similar pharma opportunities. It connects Talkspace's specialized behavioral health platform to the burgeoning high-value weight management health ecosystem.
Recognize the mental health component of weight management.
Exactly. It proves the DTE channel is capable of landing large, valuable, strategic contracts, even if it's been slow otherwise.
Okay, so we have overwhelming evidence of a successful strategic pivot. Strong financials backed by GAAP profitability and a debt-free balance sheet, and a compelling technological moat that attracts large, sophisticated payers. But in a highly regulated, high-stakes industry like healthcare, risks are always inherent. As the expert, what stands out to you as the primary headwinds they must navigate?
The first and most enduring risk remains the regulatory and clinical risk associated with AI deployment in healthcare. Talkspace is constantly fighting against the perception created by negative headlines regarding significant injury or fatalities associated with general-purpose LLMs being misapplied in medicine.
Right, the dangerous aspect the CEO mentioned.
Exactly. The ongoing need for robust clinical guardrails, strict HIPAA compliance, and demonstrable human oversight is paramount to mitigating the AI safety mandate risk. If their proprietary LLM, despite its superiority in safety features, ever fails catastrophically or faces a major security breach, it could severely damage their reputation, potentially leading to the revocation of those crucial payer contracts. They must treat AI safety as an ongoing, non-negotiable operational cost.
Okay, beyond safety and compliance, let's revisit the growth constraints. We saw the stellar payer growth, but that mega 1.2% year-over-year decline in the DTE segment, we can't just ignore that. Is this stagnation a persistent risk?
It remains a risk because it limits their diversified growth avenues. If DTE can't return to meaningful growth, they are relying almost entirely on the payer channel for acceleration. While the Novo Nordisk deal is promising, they need more evidence that their DTE sales team can consistently execute on large corporate deals without cannibalizing resources from the payer segment.
Makes sense.
Furthermore, the operational risk of maintaining and expanding the provider network capacity remains continuous. While management is currently comfortable with their 6,000 clinician network,
6,000 clinicians.
any unexpected surge in payer demand, especially following the implementation of major contracts like TRICARE or Medicare, could strain capacity. That could lead to longer wait times, which directly impacts member experience and ultimately retention rates.
Right, balancing supply and demand. And finally, let's address the financial risk implied by the narrowed EBITDA guidance. We noted their profitability, but management did slightly lower the full-year target. Doesn't that indicate some financial vulnerability?
It's less a risk of failure, I think, and more a strategic trade-off that shareholders must accept. The narrowed EBITDA guidance adjusted to $14 million to $16 million for the full year 2025. It reflects the necessary decision to continue aggressively investing ahead of anticipated demand. They are spending on technology development to enhance the AI moat, expanding marketing to drive utilization within covered populations, and, critically, continuing to hire into the provider network.
Investing for future growth.
Exactly. While this impacts near-term profitability by a few $1 million, it's necessary for laying the groundwork for sustainable, profitable growth into 2026 and beyond.
Okay, let's synthesize this for you listening. The core investment case rests firmly on the foundation of the scalable, profitable B2B2C platform. This was achieved through disciplined operational management, the decisive shrinking of the expensive DSE arm, and the maximization of the high-leverage payer relationship.
Absolutely. Confidence in the long-term outlook is reinforced by that strong balance sheet, $96 million in cash and zero debt, which provides capital for both regulatory challenges and opportunistic growth like the Wisdo acquisition. And the proactive capital return, evidenced by the $8.8 million in Q3 share repurchases, signals strong internal conviction that the long-term growth story is intact and the stock is undervalued.
The technological lead, defined by that proprietary AI data moat and its specialized safety features, showing this 50% improvement in risk identification positions Talkspace favorably as the market consolidates. General LLM competitors might struggle with the ethical and clinical compliance issues that Talkspace seems to be addressing head-on. They've created a competitive barrier that seems extremely difficult to replicate.
Which leads us to the final verdict based on management's forward guidance. They narrowed the 2025 revenue guidance to a strong $226 million to $230 million. That represents 20% to 23% year-over-year growth. But the most important takeaway for long-term investors is the outlook confirming expectations for at least 20% growth again in 2026.
Another 20% plus growth year expected.
Right. That sustained, profitable growth rate, combined with their unparalleled market scale, technological lead, and strategic entries into TRICARE and Medicare, justifies the strong, bullish consensus we're seeing in analyst upgrades across the board.
So, given the tension between speed and safety, innovation and ethics that we've seen in the deployment of AI, especially in sensitive areas like mental health, how quickly do you think the demand from payers and regulators for truly transparent and accountable AI systems will catch up to, or maybe even overtake, the sheer speed of innovation we're seeing in this critical area of healthcare?
Risk defined, portfolio protected.